Hello students, today we will learn about marginal costing. It's a very important subject and also very easy once you understand the basics. So this comes in CMA intermediate, also CA inter. Let us understand all the fundamentals of marginal costing. It is basically a type of cost accounting technique which mainly focuses on variable costs. So what are the variable costs? They are the all direct cost and variable overhead. So in the question they can give as direct material or direct labor, direct expense, and variable overhead is expressed as a percentage of direct labor cost. So in calculating the contribution, which is the major thing in marginal costing, these variable costs are used. So let us understand why it is used. Here the organization doesn't consider a fixed cost to come. Here the organization doesn't consider fixed cost to identify whether a product is making profit or not. So that product profit is called as contribution. This is some differences between marginal costing and absorption costing. Absorption costing is also called as traditional costing. In marginal costing, variable costs are used and fixed cost is regarded as period cost. Means for the full capacity per annum or per month, it is considered. And marginal cost, the cost per unit remains the same. So this is useful whether to start a business, stop a business, or to accept a new offer, or among many products which is more profitable. These information we can get from marginal costing. Marginal costing is understood using the basic formula, which is contribution. So unlike your traditional costing, the statement of marginal costing starts from sales. So let us take an example of a product whose sales value is 100. From this we have to subtract all the variable costs like direct material, direct labor, variable overhead. So for time being, let us understand all of this amounts to 70 rupee. So when you subtract 70 from 100, you get something called as contribution, which is the profit of that product, gross profit of the product. So contribution is 30. From this I subtract my fixed cost. So I'm not manufacturing only one product, I'll be manufacturing multiple products. Hence I will have multiple contribution, and from this, from the total, I subtract a fixed cost, I get the net profit. So this formula is represented as sales minus variable cost is equal to contribution, and contribution is equal to fixed cost plus profit, or contribution minus fixed cost is equal to profit. When there are certain limitations in manufacturing, such as raw material or shortage of labor or sales demand, so the contribution is divided by these limiting factors. So that is called as contribution with respect to the key factor or limiting factor. So we will understand this more when we go to the problem. For time being, just read through this slide. Next important formula is PV ratio. So we know sales minus variable cost is equal to contribution. So PV ratio is nothing but ratio of contribution over sales. If sales are not, or if the contribution data is not directly given, sometimes what happens, the data of 2 period is given. So in such cases, what you have to take, change in profit over change in sales. So these two formulas are very important when it comes to PV ratio. So the significance of PV ratio is, whatever be the scale of operation, whatever quantity the manufacturing unit produces, the PV ratio remains same. So it talks about the profitability at all volumes. So unless per unit value of sales or variable cost is not changing, the PV ratio is going to remain constant. Only when there is a change in the variable cost. So in the previous example, it was 100 sales and variable cost was 70, and PV ratio we were getting as, so contribution we were getting as 30. So PV ratio was 30 over 100, which is 30%. Let's say I produce 10,000 of this. Still the PV ratio remains the same. But if the variable cost changes to 80, my contribution is changing. So my new PV ratio is equal to 20%. So there is a concept called break-even point. This is a point where there is no profit or no loss. This is best understood using a graph. So let us take a graph where you have volumes or output in the x-axis and in the y-axis you have cost and sale data. So if there is no production, there is no variable cost. But as the production increases, the variable cost increases. So that is the behavior of variable cost. Similarly, fixed cost, whether there is production or not, there is going to be a fixed amount of cost. So hence it is a horizontal line, that is the behavior of fixed cost. At any point, the total cost is sum of variable cost and fixed cost. So for example, at 0 point, this is going to be your total cost. And as the volume increases from this point, the total cost raises in this fashion parallel to variable cost. So this is the total cost. Similarly, when I draw a total sales line, so it starts from 0 and it goes up. It is going up in this fashion. So at some point these two intersect. So this point is called as break-even point. Means whatever you produce before this line, there is a loss. And whatever you produce after this line, there is a profit. Projection of this point on the x-axis will give you break-even in terms of units of production. And projection of this point on y-axis will give you break-even in terms of sales value. So this will be rupees and this will be numbers. The formula for break-even is given by fixed cost divided by contribution per unit. So this is for units. Suppose I want to calculate in terms of rupees. So it will be fixed cost divided by PV ratio. So this will be in terms of rupees. So the fixed cost is given, which is 2,50,000. Then there is a variable cost of 20 per unit and selling price is 30 per unit. You have to calculate break-even point and sales to earn a profit of 50,000. So we know break-even is given by fixed cost is equal to fixed cost divided by PVR. Fixed cost is given, PVR is not given. So we have to calculate PVR. What is PVR? Contribution over sales. I can calculate contribution using these two data, which is 10. Sales is 30. So this will be fixed cost is 2,50,000 over contribution is 10 over 30. So I'll write 10 over 30. When I solve this, I will get break-even sales of 7,50,000. So it is 3 times of the fixed cost. And sales to earn a profit of 50,000. So the formula for that is not break-even sales. It's called target sales or desired sales is equal to fixed cost over PVR plus target profit. So this will be 2.5 lakh plus 50,000. So in the numerator 3 lakh divided by PVR 10 over 30. So this is equal to 9 lakh. So let's take another problem. The following data is given for first half and second half of the year. Sales and total cost is given. Assuming there is no changes in prices and variable costs. So this is very important data. And fixed expense are incurred equally in half year period. Calculate for the year 2015. So what you have to calculate first is PV ratio. So we know PV ratio formula is equal to contribution over sales. But only sales value is given. And contribution I can calculate if variable cost is given. Here it is not there. So in this case we cannot use this formula. We have to use change in profit over change in sales. So what is the change in profit? So I first have to calculate profit. Profit is nothing but sales minus total cost. So 10,000 in first year and 15,000 in the second year. So the change in these two values is 5,000. So I have to take positive value divided by change in sales, these two values, which is 20,000 rupees. So this is nothing but 1 over 4 or 25% is my PV ratio. So first point we have calculated. Second is break-even sales. So break-even sales is given by the formula of fixed cost divided by PVR. But in the question total cost is given, fixed cost is not there. So then how do I calculate fixed cost? I have to go to the statement of marginal costing and then find out. So the statement of marginal cost starts with sales minus variable cost is equal to contribution, then minus fixed cost is equal to profit. So let's take for the first half of the year. I know what is my sales. I don't know what is my variable cost, but I know my PVR ratio PVR is nothing but C over S. So that means C is equal to PVR into S. So I can directly calculate contribution. So my contribution comes to 70,000 into 25%, which is equal to 17,500. And I know what is my profit. My profit is 10,000. Hence, my fixed cost for the first half should be 7,500. So fixed cost, if it is for first half 7,500, total it is 15,000. So this I have calculated. Break-even sales now I have to calculate using this formula, 15,000 divided by 25%. So this comes to 60,000. So this is my break-even sales. So I have calculated break-even sales and I have calculated fixed expense. Next I have to calculate percentage of margin of safety. So margin of safety is nothing but sales minus break-even sales. So at break-even sales I have no profit or no margin. But at margin of safety sales I have some margin. I have to calculate what is that margin. So my total sales is 70 plus 90. So it is 1,60,000 and my break-even sales is 60,000. Hence my margin of safety is 1 lakh. But they are asking percentage of margin of safety. Means this I have to divide by my total sales, which is 1,60,000. So 1 over 1.6 is 62.5%. Let's take another problem. A company produces and sells a single product whose variable cost is 15 per unit. So this is the variable cost. Fixed costs have been absorbed over normal level of activity of 5 lakh units and have been calculated as 5 per unit. The current selling price is 25 per unit. This is sales. What is the profit made under marginal costing if the company sells 6,25,000 units? So this is the question. So we know first we have to find out contribution. So your statement starts with sales. So I will start with unit cost. Unit sales is 25 minus variable cost, which is 15. So that makes contribution per unit 10 rupee. So when we subtract fixed cost from this, we will get the net profit. Now the question arises, I have 5 per unit. Should I multiply with 6,25,000 units or 5 lakh units? Always remember, fixed cost is always absorbed at normal capacity. So I have produced 6,25,000 units. So my contribution will be 62,50,000 minus my fixed cost is 5 lakh units multiplied by 5 per unit. This will be 25,000. So I should not multiply this with 6,25,000 units and I will get 37,500 rupee. So this is my net profit. This is a simple problem, but it will test your fundamentals that fixed cost is absorbed over normal level of activity, and if it is anywhere within that normal level of activity, let's say it was 4 lakh units, still your fixed cost will be 25 lakh. It does not vary with quantity. Let's take this problem. A company sells its product at 15 per unit. So what is this? This is your selling price. In a period, if it produces and sells 8,000 units, it incurs a loss of 5 per unit. So if quantity is equal to 8,000, then the profit is minus 5. Okay, I'll write it as minus 5. If the volume is raised to 20,000 units, it earns a profit of 4 per unit. So quantity is equal to 20,000, then profit is equal to 4 per unit. Calculate break-even point both in terms of rupees as well as units. This problem is very easy to solve provided you know one formula, which is your PV ratio is equal to change in profit divided by change in sales. So we have to calculate change in profit. Let us take the case of 8,000 units. So what is the total sales here? I know it is 15 per unit. So sales is equal to 15 into 8,000. So this is 1,20,000. Correct? Then what is the profit or loss? Loss is minus 5 per unit. So minus 40,000. Let's call it as S1 and P1. Similarly, when we have to calculate S2, it will be 20,000 units multiplied by 15 per unit. So here I will get 3 lakh as sales and profit will be equal to 4 into 20,000, 80,000. Now what I have to do, change in profit I have to calculate. So the change is this, minus 40,000 minus 80,000. So I will take positive value. So 120 I will take. Then the change between S1 and S2, 120 minus 300. So this is 180. So this, if I express in the ratio, it will be 2 over 3. And my break even sales, I know it is fixed cost divided by PVR. Let us check in the question, have they given fixed cost anywhere? No. That means I have to calculate fixed cost for one of the period. How do I calculate? With my statement of marginal cost. So sales is equal to 1,20,000, and I don't know what is variable cost, but I can directly go to contribution because I know my PVR. So contribution is equal to sales into PVR. So 2/3 of this is my contribution, which is 80,000. Minus fixed cost, my profit is a loss, which is minus 40,000. So from 80,000, if I have to get minus 40,000, the fixed cost, it has to be 1,20,000. Correct? So the same fixed cost I will use in this formula, 1,20,000 over 2 by 3. So my break even sales will become 1,80,000. So this is my break even sales in terms of rupees. How do I calculate break even in terms of units? Simple, divided by selling price per unit. In this case, it is 15 per unit. So this will be 12,000 rupees, 12,000 units. Easy. So once you know how to use the formulas in different combinations, then marginal costing is very easy.